So now we're doing a little bit more complex cash budgeting, and I'm going to focus in on only the complex portion of the cash budget. So we've got a company and they have budgeted sales and direct material purchases as follows. So we see the budgeted sales for January, February, and March, and we see the direct material purchases for the same 3 months. We see that their sales are 40% cash and 60% credit. It collects credit sales 10% in the month of sale, 50% in the month following the sale, and 36% in the second month following sale. 4% are uncollectible, which means they turn into bad debts. The purchases are 50% cash and 50% on account. It pays purchases on account 60% in the month of purchase and 40% in the month following purchase. So this is the highest complexity that you're going to get in a cash budget. So that's why I want to carefully show you this before I integrate it into a bigger cash budget. So it says prepare a schedule of expected collections from customers for March. So we're just going to do it for 1 month. I might do it for a little bit more, but I just want to show you what's going on. So when we look at this, we have a kind of cascading effect. So I'm going to show it to you, not how you would show it on the actual cash budget, but how you would calculate it to support the cash budget. All right? So I'm just doing a collections. Now, before I do that, I'm just going to remind myself about the rules, right? So sales are 40% cash and 60% credit, also called on account. Okay, of those credit sales, 10% are in the same month, collected in the same month. All right, then 50% are collected in the following month. So if this happened in January, this is going to be collected in February. If this happened in June, this is going to be collected in July. And then it says that 36% is collected in 2 months. So if this is January, this is collected in January, this is sold in January. Sold in January, 40%, immediately collected from the 60% in January. This is in February, this is in March. Often they say in the second month following sales. And then 4% are never collected. So if we add this together, you'll notice that this makes up 100%. And we're not talking about 100% of all the sales in the month. We're talking this makes up 100% of the 60%. Right? 100% of the 60%. So what I have to do is I have to figure out how can I calculate exactly what's collected every single month. So if I look here, what I do is I do January, February, and March. And I might do April. I could do more months. All right. I'm going to do January here also. So I've got January to January. So this is January cash. This is January credit, 10%, credit, 50%, and credit, 36%. I'm never going to show the 4% because the 4% is never collected, so it shouldn't show up on my cash budget. So notice this is, the cash is 40% of the total. And these credits are all 60% of the total sales. So don't get mixed up. These percentages represent a cut of this 60%, right? These two percentages represent the total amount that was sold. So in January, I know the total amount that was sold, according to the question, total amount that was sold is 190,000. So I know the total amount for all of January was 190,000. 40% of that was collected immediately. So if I had to do this, I'm going to do 190,123 times 0.4. Okay, so let's just write that down. This is 190,123 times 40%. Okay, and we figured it out, that's 76,000. So in January, I'm going to collect $76,000. Now, in February, I'm going to collect 0 cash sales from January, 0 here and 0 here. Now, this 10% of the 60%, I'm going to collect in the same month, right? 10% collected in the same month. So I have to take 190,000. I have to multiply it by 60%, and then I have to multiply it by 10%, because 10% of the 60% will be collected in January. That's $11,400. I should have left more space, but it doesn't matter. So now, that's in January, right? That's January to January. This is January. But this is going to be collected in the following month, February, and this is going to be collected in March. So when I go over to February, I'm going to take the 190,000. I'm going to multiply it by the 60%, which are credit sales, and then I'm going to multiply it by the 50% that I collect in the month following the month of sale, right? So if I look at that, 190 times 0.6 times 0.5 is equal to 57,000. So in February, I will collect 50% of the 60% of the total amount. And then, of course, nothing in March. I'm not going to collect February sales in March, right? I'm not going to collect January sales in February, March, or April. Let's go down here. So again, we've got collecting 36% of the 60% of the $190,000. In what month? March. So I go over to March, and I'm going to do the 190,000. I'm going to multiply it by 60%, multiply it by, 36. I almost did 50. 36%. 190 times 0.6 times 0.36 is equal to 41,040. Nothing in here, right? So I'm not going to do anything here, nothing here, nothing here. So notice what's happening. There's a cascading effect. So now I can go down to February. I've got the cash sales, which are 40%. I've got the credit, which is 10%. And don't forget, it's February to February. So this 10% is going to be in the month, the same month, right? 10% collected in the same month. So this is February to February. So that's February. Then it's going to be credit sales, and it's going to be 50% in the month after, March. And then it's going to be credit sales, and it's going to be 36% in April. Now, how much are all of these sales? All of these sales are sitting at 210,000. So I'm going to do 210,000 times 40%. Over here, I'm going to do 210,000 times 60%, right? Because these two together are 100%, multiplied by 10%. That's February. This is going to be, oh my gosh, did you see my error? Oh, and students do this too. I did this February. I should have done 21. And you're all thinking, oh my God, what is she doing? That's what I was doing. I was being foolish without checking my months. That's why I write down February, February to February, February to February. So this is absolutely not, oh, I'm so glad I made this mistake, because I can show you what this mistake looks like, so you don't make it. Multiply by 10%. Don't make that mistakes. Those mistakes, blah. All right, February to February. Now I got it. March to March. So in March, it's going to be 210,000 multiplied by 60%, and then multiplied by 50%. And then April to April. So this is 210,000 multiplied by 60% multiplied by 36, I'm running out of space, percent. All right, now I'm going to calculate those numbers all together. This is 84,000. It would be better if I had left spaces in between so I had more room. So I apologize for squishing it up. And then I'm going to do 210, 123 times 0.6 times 0.5, 63, 123, 210, 123 times 0.6 times 0.36, 45,360. Okay, now I can do March, because March is what I'm looking for, right? I'm just looking for March. I'm just showing you. Again, see how it cascades and then it takes the steps down. This should be nothing, right? This should be nothing. So it's cascading down. And then March, you'll see the same kind of thing if I'm careful. So I've got March here. And I'm going to do March cash, which we know is 40% of the total. And then I'm going to do credit. And this is March, March to March. And this is 10%. This is March again. And then credit, this is 50% in April. And then credit, this is 36% in May. Now, what is the total amount of sales in March? So I go over here. March had $300,000 in sales. So that's 40% multiplied by the 300,000. I'm going to do March to March. So I go over here. This time I'm smarter. I do March to March. I'm going to do 300,000 multiplied by 40%. Now, credit sales in March are going to be 10% of the 60%, right? Because again, this is 60%. All of the credit sales, let me put it at a zero, are 60%. All of the credit sales are 60%. So I'm going to take 300,000, 60%, 10%. It's going to be in March, way over here. 300,000 multiplied by 60% multiplied by 10%, March to March. 300,000, 60, 50. April. April. 300,000 multiplied by 60% multiplied by 50%. All right, let's do the math. Remember, times multiply by 0.6 to get the credit sales first, and then the amount that we're going to collect of those credit sales. 18,000. Oops. This is 90,000. And if we had May and June, we can keep going, right? So now I can calculate the total amount that's going to be collected. I can't calculate, so notice what's happening here. I have some of January sales, some of February sales, some of March. So I need this month and 2 months previous. I need this month and 2 months previous. So in order to finish February, I actually need December. I need this month, I need December, and I need November. So I can't add up January and February because I'm missing some of those months, right? I could add up April if I still had April sales way down here, right? Which I don't. So the only one I can actually add up is March, because you can see, how do I know there's 3 months? 1, 2, 3 in the month, in the same month, in the following month, in the month after that. So I know there's got to be 3. Right. So I can add this up, and this will tell me what are my March cash collections. My total March collections are $242,040. That's what the total cash collections are. All right. So when we were asked in the question to do a schedule of expected cash collections from customers in March, this is the schedule. And this is how I can complicate a cash budget, because I'm asking you to do this cascading thing. And you'll notice, right, I'm looking at this, I need 3. If I was doing April, I would need 3. If I was doing February, I need 3. January, I need 3. So keep in mind that I need all months represented, because I'm collecting some of the accounts receivable here. I'm collecting even more accounts receivable here from February. I'm collecting January's accounts receivable, February's accounts receivable, and here I'm collecting March accounts receivable. And then I'm collecting March accounts receivable, and if I had May, I would be collecting some of March accounts receivable in May. So that's my cash collections. Let's look at how we do cash disbursements. Very similar. Schedule of expected payments for direct materials. So now I'm going back up here, and I'm going to write down the information for the payments. And it says their purchases are 50% cash and 50% on account. Also called for credit. And then they say it pays purchases on account 60% in the month of purchase and 40% in the month following the purchase. %40 paid in following month. Now I'm going to do the exact same thing that I did before. I'm going to do a schedule of expected payments. And I'm going to do the cascading effect, but for a payment instead of a collection. So I'm still going to have January, February, and March. I'm going to put April, even though we don't need April. We don't actually need January, February. I just want to show it, right? So January to January goes first. So I'm going to do January. And instead of saying January cash, I'm going to say January pay. So if we purchase in January, how much do we pay in January? Well, we know it's 50% cash. And then what's going to happen is we have credit. And that first credit, so 60% is paid in the month of the purchase. So this is 60%. And then we're going to have credit. And we're going to have 40%, right? 60% in the month of purchase, 40% in the following month. So this is going to represent 50% of the total. What is the total that we have to pay? $30,000. So I'm going to put that total $30,000 right here. So now I can take the 30,000, multiply it by the 50. And then don't forget that credit is still going to, so this is January, that credit is going to be paid in the month of purchase. So this is still January and this is February because this is the month after purchase. So $30,000 multiplied by 50 multiplied by 60. Because January to January. Now February to February, this is going to be 30,000 multiplied by 50 multiplied by 40. I'm just going to calculate these numbers. Well, we know that this is 15,000. Now 30, 1, 2, 3 multiplied 0.5, 0.6 is equal to 9,000. $6,000. All right, now let's move on to February. The payments are going to be 50%. And then the credit is going, and don't forget that's in February, 60% in February, and then credit is going to be 40% in March. We know that this, this is going to be 50%, and then this whole thing, the amount, is going to be $35,000. So $35,000 multiplied by the 50. And don't forget, February to February. I'm not going to make the same mistake. February to February. So this is 35,000 multiplied by 50%. Then February to February, 35, 50, 60. Then March to March, it's going to be 35, 50, 40. Okay, now I'm going to do the calculation. 17,500. $10,500. Let's keep going. We're now doing March payments, which is going to be 50%, and that's going to be in March. Then we've got credit. That's going to be 60% in March. And then credit, it's going to be 40% in March, April. This is going to make up 50%. 50 plus 50 is 100. Excellent. This whole amount. And I didn't do that here. I forgot to do that here. I didn't do it correctly. It's all of this. All of this is going to be the 45,000. So I'm going to do March to March. So I'm going to do 45,000 multiplied by 50. Then I'm going to do 45, 50%, 60% in the month of March. And then I'm going to do 45,000, 50%, 40% in the month of April. I know it's getting really small. Okay, let's do the math. 20, oops, where am I? Oops, I did it in the wrong place. 22,500. $13,500. This is 9,123. So you can see this cascading effect, right? 2 months here. I'm going to collect 40% of January's in February, right? So you can see this cascading effect that's going down here. I've got 1, 2, 3. So I need another month from December here. Here I've got 1, 2, 3. So 2 in the month of March, 1 in the month of February. So I could calculate February. All the information is here for February. I have all the information for March. I don't have all the information for April. But we are only asked to do March, so I'm going to add those together. So the total disbursements are $43,000. So total payments is $43,000 just for the direct materials, right? Just for direct materials for March. That's it. So we can see we now have the total disbursements, cash disbursements, there we go, for the month of March, and we have the total cash collections. Wait a minute, let me go down. There, total cash collections for the month of March. This means that if we had the other information about the overhead budget and the direct labor budget and the selling and admin budget, we could actually calculate the total cash position. at the end of the period. But I wanted to highlight exactly how to calculate cash collections and cash payments if they are all not done in the same month. So this is how I can increase the complexity of a cash budget. I'm going to continue with a more complex example in the next video.